Audie was just talking about how Ben Felix had a video come out about covered call investors and how they know that the returns are lower, but they still do it anyway. Can you kind of give me your thoughts on why they do this?
Yeah, so from what I saw is that I think everyone in the cover call community kind of knows they're probably going to underperform their underlying. In this case, let's say QQQ or SPY or whatever it might be. But typically, they want to not sell shares in retirement, or they can do what they want to with the distributions, right? They can invest it how they want to, if that makes sense. So they have more control as to where that, I guess, return gets put towards, right? Whether it be back into the same cover call ETF or live in stock, wherever it might be. But I think it's also a dopamine hit where it's like, hey, I'm getting, let's say you have a, I don't know, like 500K portfolio and you're making like 10, 15%. That's like 50, $60,000 a year. You see that as a payment, right? But I feel like for growth, it's a little bit better because let's say you get 10 to 20% return on your money, you will see those like spikes every day, like every green day, right? It's kind of like a dividend, but it's not actually hitting your bank account, if that makes sense, you know?
So before you were telling me that you think that they're trying to just like replace their income ASAP. So I think that there might be two different communities too, right? So there's dividend community where it's like dividends only, but then there's hybrid approach, which in my opinion, hybrid is like definitely wrong because of rehypothecation, because of the massive NAV erosion. I can see an argument to be made for dividends, but I think the thing is that we have a different goal of we want a much wealthier lifestyle, and that you had talked before a little bit about how before you discovered recycler money and things like that you were, if you say lost your job, what do you do for income? What's your answer to that?
Yeah, and I think that's where the cover call ETF investing community kind of like has a point. It's like if you lose your job and you have no, like, I guess, incoming income, what are you supposed to do, right? How are you supposed to replace your income? But the way I think about it is that it's actually a liquidity issue, right? Where can I get liquidity to fund my lifestyle if I don't have any income coming in, right? So that's when I saw like kind of like the cycling money approach, where it's like you have a giant portfolio and you're able to take a small pieces of it every month through margin. You're able to fund your lifestyle in a sense, but also you're not selling shares to actually fund your lifestyle. That way, your portfolio actually grows over time. I feel like covered call ETF investors still want that. They don't want to sell their shares, but they still want that income. So it's more of a liquidity issue than it is like an income issue, I would say. Right.
And they don't really see much growth. They cap all of their growth for their upside. They pay much more in taxes. A lot of them don't know what rehypothecation is. Shout out to Margin Mindset for pointing it out. None of us read our margin agreement. We all just click next,
Yeah.
agree. And the thing is that they're giving up roughly maybe about a third of their total return. They miss out on the bull runs. And the thing is, when the market's going to go down, they participate with us, maybe at a little bit of a slower rate, but then they miss out on that really big rebound that tends to happen afterwards. And I like how you talked about how there is this misconception that I'd really like to break where it's like if one of us would lose our job or something, we aren't just going to like start selling shares out of our portfolio. We're just going to use margin and just apply for a new job until we get a new job, even if it pays less than we're currently making, just to have some incoming cash flow.
And then once your portfolio does like grow to a set amount, let's say that number is like, I think for you it's like 3 to 5 million, right? Because you're using high growth ETFs, you're actually able to achieve that fire number per se faster or
Way faster.
way faster. And when you hit that fire number, you're actually able to withdraw from your margin account and sell. If you really want, you can sell at all time highs to trim your margin balance to get a better, I guess, margin health as well, right? So
Yeah, well said. And the thing is, people are keep asking me. I'm going to make a video about it eventually here, but people will ask me like, "How are you going to live off of this in the
yeah.
future? Like, you can't just borrow forever because it's going to get indefinitely bigger." Well, guess what? I built a calculator, and it shows what your margin health will turn to, and it shows that 3 million really for me is that number. I could borrow about 120,000 indefinitely, and of course, then you have to worry about drawdowns, right? So if there's a big drawdown, the lowest my margin health gets when I do that is about 62%. But that might be a little too low, right? So we can then do what Audie had just suggested. And during some bull years or every maybe 5 years or so, sell a couple 100,000. Who cares? Pay down some of that margin at that time. And then I continue to ride it up and I'm selling way less. I'm maximizing growth. I'm minimizing taxes. Total return is the only thing that matters. I'd really like to put this covered call thing to rest. I know I'm never going to just defeat the covered call world by myself, but
But to play a little bit devil's advocate, like if a market is going down and you're seeing those distributions, typically those covered call ETFs are gonna go down less, if that makes sense too. So and seeing
Yeah.
consistent income or like distributions, I should say, does keep a certain individual invested for longer, right? Compared to just selling your shares when there is a big downturn. So obviously, like me and you are highly convinced in high growth ETFs, but whatever your strategy is to like, be invested in the market, I think it's best, right? So
I think that the dividend approach can be strong if you aren't going to do the hybrid approach personally. I think that dividends, like if you want to just replace your income, maybe something like OVL, maybe something like QQQI, but don't pair it with margin or have it in a separate account from margin. I also think that if you want to do something like that and you want like the best outcome, the way to do it would be to do pure growth until you're a few years from retirement, maybe 3 to 5 years from your retirement target, and you want income from your portfolio in the future without selling. You then open a new brokerage. So now you have two
ooh,
brokerages. You have your growth here. And then this other brokerage, you decide, hey, I'm going to borrow margin, say 300,000 from my margin account, and I'm going to fund this dividend portfolio over here. Now, here you have no margin, so you're not getting taxed with rehypothecation. They're not paying you in lieu of dividends, and you're getting the full dividend amount, paying the least amount in taxes. Now, those last 3 years, you use the income from this portfolio plus your job to help pay back the margin over here, enter retirement, and you have no margin debt. And now you have
hmm.
these two different portfolios helping fund your retirement.
And I think we mentioned this before too, but like I think you and I had a similar strategy or similar mindset where it's like we have our margin account and they have our retirement accounts. For our margin accounts, we want to kind of keep that as our main account where we kind of live from. And then we use our retirement accounts eventually to hopefully pay down that margin because at the time of like 59, 65 or whatever, we're
Yep.
forced to take out, I guess, money from our retirement accounts either way. So might as well just put that towards uh, getting a better margin health on our margin account, right? So
So, good point. We won't be forced at that age. That's the earliest age we can start to take it out. But eventually, we're going to be forced to take
yeah.
distributions. So then you want to be like, you have to use the money for something. Might as well use it then to sort of pay down your margin, keep your margin in check without selling from your margin account, and let that grow indefinitely forever. Not only that, but then we're going to have Social Security around that time. So our growth portfolio doesn't need to last forever without selling shares. It only needs to last until 59 and a half. That's why if you get to 3 million and you're at like 42 years old or something, which really can happen, you can build a $3 million portfolio way faster than you think by doing this. Then when you're say 42 years old, every 5-ish years or so, you just sell a couple 100,000 if you need to. You get to 60 and now you have your retirement account unlock. A few years later, you have your social security unlock. And now your margin, you don't have to be selling any more shares. This gets it to continue to grow forever. And again, I have a calculator. I'll show it in a future video, but I think people are misunderstanding that. And another point you made the other day is since we won't be generating income like dividend investors and covered call investors and hybrid investors, we have the ability to take advantage of, and this might sound shitty, but we have the ability to take advantage of maybe government programs. Maybe we can send our kids to college for free. Maybe we can get like, I don't want to sound really shitty, but food stamps or something.
Yeah.
Like, because we have no income. It's all coming from our portfolio debt, which is not income because you have to pay it back. The government considers it debt. And that's way more powerful than people think.